Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. About a week ago, I suggested that I was going to be highlighting what I consider to be the best investment in AI stocks. Now, there was a reason that I didn't go ahead and follow up with that, and I'll be covering that in the video. But it is now time. I've taken the time to go ahead and do a lot of research on this particular stock, and I think it's time for me to go ahead and feature it. Now, I want to be clear about something. I'm not saying it's the best company in AI, but I am suggesting that it's the best investment in AI based on valuation and growth potential. And let me go to FastGraphs and explain exactly what I'm talking about. The company is Super Micro Computer, and it's been a little bit controversial here recently, and I'll be again talking about that, because the company has delayed their financial statements and they were hit with a short seller. It's kind of a scathing article, and we'll talk about that and talk about Supermicro's response. But the first thing I want to do is just give you my perspective on the company, utilizing FastGraphs and its flexible, dynamic, analytical power. So the first thing I'm going to look at here, I've got a maximum time frame up. I don't have price on this graph. What I'm looking at is adjusted operating earnings, and I've also got the normal price to earnings PE ratio, the blue line on the graph. What you can clearly see here, earnings growth over this long-term time frame has averaged 25.53%. However, you can also see by this graph that there's been this huge acceleration in earnings over the last 3 years and expected to continue over the next 2 or 3 years. All right, but using the power of FastGraphs, dynamic nature, let's go ahead and go back in time here, and let's scroll back in time, back to 2022, just after COVID. And now let me put annual stock prices or weekly closing stock prices on the graph. And what I want you to see here is that SMCI stock price has tracked earnings very, very closely going back over this time frame. And if I pull it back a little more, you'll see that the correlation between earnings, results, and stock price has been very clear. And you can see periods of overvaluation, you can see periods of undervaluation, and you can clearly see that buying the stock when it was undervalued generated very strong returns. Buying the stock when it was overvalued could have put you in a position where you had very negative returns over a period of time. But the company was growing about 11%. What I've got is a time frame here from 2007 to 2020, okay? And I can scroll back some more, and you can see that this 12% growth and this fact of this stock price correlating to the company's earnings was very profound. But now let's start going forward here a little bit. And all of a sudden, we had this big surge in growth. And in 2023, and this company has a June fiscal year, we saw that the earnings grew by 128% in fiscal year 2022 after dropping 10% in 2021. And then they grew by 109% in fiscal 2023. All right, moving forward now and looking at the stock over the last 12 years, including almost 3 years of forecast data here, the average earnings growth rate was 30.78%. Now, this is a very important calculation because when you're dealing with high growth stocks, the PEG ratio comes into effect. And that's when the PE ratio equals the growth rate. And this is for fast growing companies. FastGraphs automatically applies a P equals growth rate formula. Now we cap it at 30 times earnings. And here we're looking at an orange line that represents a PE of 30. Now you can see here that the stock by beginning of March of 2024, it got up to 60 times earnings. And we had this huge run up in the stock price. And then we had this correction, which happened to a lot of AI stocks, NVIDIA and Broadcom and many others, even Dell Computer. And then we had this short seller announcement, and we saw the stock drop precipitously. And we'll talk more about that a little bit later. But what I want to do is I want to keep honing in. I want to shorten the time frame by another 2 years here. And I want you to notice that the growth rate now is over 40%. The normal price earnings ratio during this time frame has been about 14 or 15. Remember, these numbers always should be looked at in terms of ranges. Taking off another year, we have 42% growth. chopping off a couple of other years, we have 53, almost 53% growth. And we can see that the forecast growth, or the growth going forward, is expected to be very strong. Okay, and the stock price is now trading closer to a normal PE. It's trading at about 16.84 times blended PE, giving an earnings yield of almost 6%. Now that would be, I would consider that for a normal company a little high in terms of overvaluation, but just moderately. In other words, 15 is my ideal PE ratio for companies growing at normal rates. So 16.8 is perhaps a little high, but only marginally so. But let's go into forecasting, because this is where the decisions need to be made. Now, the consensus of analysts, and there are 15 analysts that were following the stock in 2024. There are, and again, fiscal year was ended in June, okay? There are 12 analysts giving a forecast for 2025, which will be at the end of June of 2025, and they're looking for 55% growth this year. And then it goes to 11 analysts, and then as you go further out here, you get down to 2 analysts. Okay, now the analyst scorecard in this company has been decent. They've missed 27% of the time on a 1-year forward forecast and equally 27% of the time on a 2-year forecast. And so you can, using fast graphs, look at where they had their misses and where they had their earnings. But generally, the analysts have been pretty good. Now, I also want you to see the trend in analyst estimates here. 6 months ago, for fiscal year 2025, which we're currently in, analysts originally were thinking $29.67 a share. Then they raised the estimate to $33, and then they increased the estimate to $34.64. And then they've dropped it a little bit since the most recent previous estimate to $34.34, just about a 30-cent drop here. But the point is, they're looking for 30% growth. So using a PE ratio of 30, which is what we cap it at fast graphs, just for prudence sake. So this orange line would be a PEG ratio basically of 1. All right, if you look at the potential returns, and one of the beauties of fast graphs is with our forecasting calculators here, instead of buying a stock and hoping, you can actually calculate what the potential rate of returns might be. So if the company did grow at 55%, and traded at a 30 multiple, and right now it's at a 16 multiple, that would give you a more than double by June of 2025, the end of this fiscal year. If you went out here to 2026, that would give you an 89% annualized rate of return. And again, I won't go any further than that, because here we're getting down to where we almost don't really have a consensus. We just have 2 analysts. But let's go to the normal multiple, because as I previously showed, this company has traded at a relatively low multiple historically. Okay, but I want to visit that again. The reason it traded at a low multiple historically, and let me go into the historical graph here, is because the company was only growing at 10 or 12% a year back here. Okay, 11% for this period that I've got here. And that was giving it about a 15 multiple, which I would consider normal for a company growing at less than 15% a year. But now what's happened is, as we go into these future years, as I've shown you already, we've seen growth accelerating. Now the forecast growth is for the company to grow at 32% a year. Now, if we apply a normal multiple for the last 5 years, the normal multiple has been about 13 times earnings. This would be a very, very conservative multiple, and it would be actually less than the company is currently trading at, as you can see. But it would be entering the valuation corridor, but keep in mind the dynamic nature of over 32% growth. If you go out here to the end of 2026, this would give you the opportunity to average 21%. Now, if the PE was trading at, we'll call it 17 times earnings here, and this is 17.47, you could be analyzing at 40% a year. If it traded at anything near its growth rate, like we talked about here, then you would have these really incredible rates of return. So FastGraphs has given us the ability to do these various what-if calculations. Bottom line is, if you adhere to the P equals growth rate formula for very fast-growing companies that Peter Lynch basically postulated originally, this company has tremendous growth ahead of it, and it's a tremendous rate of return for those investors who are willing to take the risk of investing in it. Now, the company has responded to the short seller arguments, and they have delayed their financial statements. I do want to say something clear. I'm long this stock, and I'm at a loss on it right now. And what I'm looking to, as long as these fundamentals continue to basically show like they are, and analysts have still continuing to forecast this, and I've got some compelling reasons why I think these numbers are good, and I'm going to get into that next. I'm waiting to find out more color on the financial statement release before I invest money. Now, if it comes out really good news, the stock could rally and I could miss some upside. But on the other hand, if it comes out and it's really bad news, it could be further downside. Nevertheless, I don't think anything that the short seller pointed out really affects the long-term growth potential of this company. Okay, now I want to go to our fiscal fitness section here, and I want to talk about a few things that show up on the company. When the stock price was really high in 2024, they did issue some shares, okay, which I think was really a smart thing to do because the stock was expensive. Now, I do want to look at some of the basic metrics here. On a margin basis for the most recent quarter, and I've got the quarterly data here that was reported, that was the June of 2024 quarter, their gross margin was 11%, but their margins have been falling. And that's another negative that analysts have been pointing out about the stocks. But it's still a pretty good margin. The operating margin fell to 6.47%, and their net margin to 6.64%. And that's from about 10.5% on the March quarter. But they still are generating margin. Now, their return on invested capital is averaging almost 26%. The return on equity for the last quarter was actually increasing a little and was up to 32.4%. Okay, their debt to equity ratio is very comfortable, but the company does have about a 35% debt to equity ratio. And as I pointed out in the historical graph, they have an even lower debt to capital ratio. Their sales growth has been very, very strong. Okay, this is top line growth. Their bottom line has been under a little pressure with margin, but the company is talking about fixing that. Now, I did a lot of research on this stock, and I gathered that research up in a PowerPoint presentation, and I'm going to go ahead and share that with you next. With this PowerPoint presentation, I will summarize what I discovered through my research on Supermicro. First of all, they provide a comprehensive range of IT solutions, including high-performance servers and storage systems, which are tailored for various applications. They also have modular components for customized IT solutions as building blocks. They also have solutions for the Internet of Things and embedded systems. They also have advanced networking devices, workstations, and gaming products, high-end workstations and gaming systems. The company's total IT solutions encompass complete servers, storage systems, modular blade servers, workstations, full rack scale solutions, networking devices, and server management and security software. SMCI also has AI agreements with companies like Dell and NVIDIA. Supermicro announced the launch of 3 NVIDIA-based supercluster solutions optimized for generative AI workloads, which are ideal for training large language models with up to trillions of parameters. Supermicro is responsible for building half of the servers for a.k.a. supercomputer, which is expected to be operational by next fall. This product underscores the significant role of Supermicro and NVIDIA in advancing AI infrastructure. Converge and Supermicro have also created a collaboration in the Philippines. Converge has partnered with Supermicro to establish AI-powered green data centers in the Philippines. This collaboration involves developing total IT rack-scale liquid-cooled solutions using advanced NVIDIA GPU. ANSYS, NVIDIA, and Supermicro also have a partnership, and they've partnered to enhance the efficiency of multi-physics simulations. This collaboration provides turnkey hardware solutions that significantly accelerate ANSYS simulation capabilities, leveraging NVIDIA's H100 GPUs, L40S GPUs, and the Grace CPU superchip. The integration aims to improve performance, cost, and productivity in simulation tasks. SEMA.ai and Supermicro also have collaborated with NVIDIA and Supermicro is working on bringing smart city solutions to the embedded edge. This partnership combines NVIDIA's AI video analytics solutions with Supermicro's edge appliances, powered by SEMA.ai's machine learning system on a chip platform. The SEMA AI partnership is open to various stakeholders, including sensor vendors, original equipment manufacturers, system integrators, and independent software vendors. In conclusion, the partnership between NVIDIA, Supermicro, Vast Data, SEMA.ai, and other entities highlight a concentrated effort to advance AI infrastructure and applications. These collaborations are pivotal in simplifying AI deployment, enhancing performance, and scaling AI operations across various industries. Supermicro and NVIDIA also have several collaborations. Supermicro has been actively cooperating with NVIDIA to develop GPU-optimized products for AI, focusing on generative AI workloads and large language models. Key developments in this collaboration is that Supermicro has launched 3 NVIDIA-based supercluster solutions optimized for generative AI workloads, ideal for training large language models with up to trillions of parameters. These solutions address critical bottlenecks in generative AI, such as GPU memory bandwidth and capacity, to run large language models efficiently. The collaboration with Vast Data delivers a full-stack, end-to-end AI solution that simplifies the creation and expansion of large-scale AI deployments. In conclusion, the partnerships between NVIDIA, Supermicro, SEMA.ai, and other entities highlight a concentrated effort to advance AI infrastructure and applications. These collaborations are pivotal in simplifying AI development, enhancing performance, and scaling AI operations across various industries. The Voluntary AI Standards Agreement, led by the White House, further underscores the importance of ethical and safe AI development. By integrating cutting-edge technologies and adhering to stringent standards, these collaborations are set to drive significant advancements in AI, benefiting a wide range of applications from smart cities to large-scale AI deployments. How will SCMI prosper from these AI agreements? NVIDIA and Hugging Face partnership have partnered together to provide generative AI supercomputing to millions of developers. This collaboration will significantly impact SCMI by enhancing its AI capabilities. The benefits for SCMI are they can leverage the generative AI supercomputing capabilities provided by NVIDIA and Hugging Face to develop advanced AI models tailored to specific supply chain needs. This will enable SCMI to optimize operations and improve efficiency. Hugging Face's new service, Training Cluster as a Service, simplifies the creation of custom AI models. SCMI can use this service to develop models that address unique supply chain challenges, leading to more effective and efficient operations. The integration of GDX Cloud with Hugging Face offers also one-click access to NVIDIA's multi-node AI supercomputing platform. This will allow SCMI to quickly deploy and scale AI solutions, enhancing its ability to respond to market demands. Amazon Web Services and NVIDIA collaboration have announced a strategic collaboration to offer new supercomputing infrastructure, software, and services for generative AI. This partnership will provide SCMI with cutting-edge tools to enhance its supply chain operations. The benefits for SMI are that they can utilize the first cloud AI supercomputer with NVIDIA Grace Hopper superchip and Amazon Web Services multi-cluster scalability to handle complex supply chain tasks more efficiently. This project aims to create the world's fastest GPU-powered AI supercomputer. This is Project SEMA. SCMI can leverage this powerful infrastructure for AI research and custom model development, leading to innovative supply chain solutions. Enhanced AI tools. NVIDIA's NeMo large language model framework, NeMo Retriever, and BioNeMo on Amazon Web Services will boost SCMI's generative AI development for custom models, semantic retrieval, and other applications, improving decision-making and operational efficiency. NVIDIA AI-powered intelligent supply chain management solutions are transforming supply chain management by delivering unprecedented efficiency and accuracy. The benefits for SCMI are intelligent video analytics can be utilized to increase the accuracy of orders picked, packed, and shipped, leading to more efficient operations. Also, demand forecasting. NVIDIA's AI solutions enable SCMI to forecast demand accurately, ensuring that the right products are available at the right time, thus improving customer satisfaction. Also, optimization of last mile delivery. With NVIDIA COPS, SCMI can optimize last mile delivery through dynamic rerouting and simulations, enhancing delivery speed and reliability. Decision intelligence and casual AI in manufacturing are revolutionizing manufacturing by enhancing automation, collaboration, and intelligence within operations. The benefits for SMI is they can implement decision-making intelligence to drive insights to the point of action, improving operational efficiency and responsiveness. Casual AI for better insights. By using casual AI, SCMI can pair data models with knowledge models based on domain experience, leading to more accurate and actionable insights. Scalable knowledge models. Advances in AI allow SCMI to ingest domain expertise at scale into knowledge models, enhancing the speed and accuracy of decision-making in a competitive environment. AI and supply chain market growth is projected to reach $58.55 billion by 2031, driven by increasing AI integration and the demand for cloud-based solutions. The benefits for SCMI, market growth opportunities, where they can capitalize on the growing AI and supply chain market, which is expected to grow at a compounded annual growth rate of 40.4% from now till 2031. Enhanced visibility and transparency. AI integration will provide SCMI with greater visibility and transparency in supply chain operations, building trust and improving process efficiencies. Cloud-based solutions. The rising demand for cloud-based solutions will enable SCMI to deploy flexible and affordable AI solutions, enhancing operational efficiency and scalability. The conclusion, SCMI stands to gain significantly from the recent AI agreements involving NVIDIA and other key players. These collaborations will provide SCMI with advanced AI tools, enhanced decision-making capabilities, and opportunities to capitalize on the growing AI and supply chain market. By leveraging these technological advancements, SCMI can optimize its operations, improve efficiency, and drive innovation in supply chain management. So turning back now to fast graphs, this tremendous growth in AI has been significant. Now you can see that the original hype in AI got the stock really expensive. We've now had a major correction. Looking at even from the standpoint of using a normal multiple, which is extremely low here, you would still have this really great opportunity to earn a very high rate of return. I consider this almost the worst case situation. Now, you can all do your own research on this stock. Here I'm going to just go into Yahoo Finance very quickly and basically look at some of the recent news on SCMI. Zacks about an hour ago, as this video is being reported, they highlighted some bulls and bears. I guess they mentioned SMCI in that. And now there was this Hindenburg report. That's the short seller. Hindenburg did issue a scathing report. SMCI has denied that report and refuted it. Now the question that comes up, when they finally launch their financial statements, what are we going to find? I'm waiting, as I said earlier, to see that before I make any decision. The stock is up very modestly today, up less than 0.5%. But I don't know if we're bottoming now or others are waiting to see, like I am, what's going to happen when they finally do produce their financial statements. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, bringing you my updated research on SMCI, which I believe is a great investment opportunity in AI based on valuation and growth potential. Now, the company does have some issues. Again, the company's working to turn their dropping profit margins down, and they've addressed that issue in various reports, and you can check it out on their website. We have this short seller, but the damage there may have already been done. The real question is, when they do launch their next financial, remember the company's changed auditors, so we're looking to see that the auditors don't give them a clean bill of health, basically, that financial reporting is basically commensurate with rules and regulations and best practices. So let's see what happens to that. But anyway, I'm very Excited about the opportunity to invest in this growth stock. This is a growth stock. It contains a lot more risk than most stocks do. I want you to keep that in mind. But if you're looking for growth at a reasonable price or GARP, SMCI seems to fit that bill. The company's products and growth potential is enormous. And even if the short sellers are correct, I don't think it really changes the long-term growth potential for all the reasons I articulated in the PowerPoint presentation. Hope you enjoyed this video. I know it's been a long video, but I hope you enjoyed it. If you did, give me a like, ring the bell, subscribe to the channel, and also take a look at FastGraphs. What an indispensable tool to be able to analyze companies very comprehensively and very dynamically. Thanks for watching, and we'll talk to you again real soon.